Good afternoon and welcome to this ACT technical webinar where we'll be looking at European OTC derivative regulation and the implications for non-financial companies. I'd first like to thank Goldman Sachs for their sponsorship. I'm Martin O'Donovan and I'm responsible for policy and technical here at the ACT. I'll be running through the basic shape of the rules as applied under EMIR, where they've come from, the main thrust of clearing, reporting, confirmations, and then we'll move across for Jenny from Goldman Sachs to talk about other derivative regulation that's brewing at the moment, because EMIR is not the only one. We'll then introduce Jo from MISIS, who can tell us a little bit about what's going on in her company. And at the end, we'll have time for questions. I should point out that you can ask questions at any stage during this presentation. There's a button on the right-hand side of your screen called Ask a Question. Click on that and you'll get a pop-up. You can type in your email address and question and submit it. And we'll try and deal with that at the end. If you think back to the financial crisis, one of the things that the authorities were very concerned about was that liquidity across the financial system dried up. And much of that credit exposures between financial institutions that could arise from the network of derivatives that existed. And as a result of that, at the G20 summit, the leaders sought to reduce the risk of this sort of contagion by requiring authorities to come up with a set of regulations. Those were designed to require the electronic trading of standardized derivatives where appropriate and central clearing. They required derivatives to be reported to a trade repository, and that non-centrally cleared contracts should be subject to a higher capital requirement. And then a little bit later, they added a couple of extra ideas, namely around risk mitigation. And as a result of that, we've ended up with DoddFrank in the States, EMIR in Europe, and the Capital Requirements Directive. The history of EMIR, it's been running for a while now, but was finally approved by the European Parliament in July last year. It's a regulation, so it becomes binding law in the UK with no further action, and it entered into force on the 16th of August. That was the sort of level one legislation, as they call it. Subsequently, level two or secondary legislation is passed through, and that introduces the detail. And that's actually only happened fairly recently, with the final approvals in February, and we now know that the first start date for these regulatory technical standards will be the 15th of March. There's still one section on non-centrally cleared derivatives, which is outstanding, and that's indicative of the rather piecemeal approach to the legislation. Before we get into the main thrust of the presentation, we've got a poll that should be coming up on your screen now. This is a question for you. If you want to come back to this later, there is a button and you can select poll 1. You select the little button first next to the presenter box and then select poll 1. Bring out the first question. Has your company already started a program of preparation for EMIR? And the question is, if you have a selection of answers there, tick the one that's appropriate. Yes, you're already taking steps and they're going. No, but we're starting to think about it. Or quite simply, no, we haven't got going on that. Now, I'd like to move on to poll question 2. If you've lost the screen at the moment, I apologize. apologise. We'll be back with that any minute now. Right, apologies for that little blip there. We're now on to poll question 2, and this is asking, have your banks and other service providers started to offer EMIR-related advice or services? And the selected answers, please choose. Yes, this is being offered by many parties. Yes, but we're only just starting to hear from 1 or 2 providers. Or no, outside providers are silent on the matter. So let's move now on to the actual legislation and what the requirements are. The main plank of EMIR is all to do with clearing. The idea here is that for larger companies, any deals they do with their banks are voted across to a central counterparty, and that then stands between you and the bank. The CCP will require some form of credit risk mitigation, and it does that by taking collateral. That will be in the form of initial margin, which could be, say, 5% or so of the nominal amount of your deals, plus a variation margin based on the daily mark-to-market. Now, this clearing obligation only applies to financial counterparties and non-financial counterparties over a certain threshold, this clearing threshold. And we call these NFC pluses. Pension scheme, by the way, are treated as financial counterparties. The thresholds are shown in the box here. So we've got on things like interest rate derivatives, you can run up to 3 billion notional amount before you cross the threshold. In terms of that threshold level, the good news is that in accumulating the deals you've got, hedging transactions don't count. And hedging is defined as objectively measurable as reducing risks related to the commercial activity or treasury financing activity of that company or your group. The exact detail of that is in one of these regulatory technical standards, and it's probably worth checking that at some stage, and you can find the links to that through the ACT webpage. On the front, under the heading of agenda, you'll find a link to our briefing note, and there are various other links from there through to useful sites. The basic definition of hedging is quite wide. Combinations of derivatives are okay. Portfolio hedging, proxy hedging, all count as hedging. You don't have to be getting IFRS accounting hedging for it to count for EMIR purposes, but if you do get IFRS accounting, then you're definitely a hedge for the purpose of this test. We suspect that most companies will therefore not be caught by clearing, because for most of us, our derivative activity is virtually 100%, if not 100%, done for hedging purposes. But if you are doing non-hedging, then watch out, because those limits could be accumulated to quite quickly. And I'll quickly run through why that might be. In getting to calculate what counts towards that limit, you look at your worldwide derivative activity. You include intra-group transactions, is the gross notional amounts, and there's no netting. So if you've done a deal and then subsequently close it off by doing an equal and opposite one, although there's no net exposure, both those transactions will count towards the gross total. If you cross the threshold in one asset class, it brings everything else into clearing, and that's been a particular concern of people who've got large commodity trading operations. Once you go over the threshold, you have to notify the authorities, but you don't actually come into clearing until you've exceeded the threshold on a rolling basis over 30 days. And similarly, if you drop below the threshold on a rolling basis over 30 days, you come out from the obligation towards mandatory clearing. if you are an NFC plus, you've crossed the threshold, you're then into mandatory clearing. The timetable for that is such that it's not starting for a little while yet, because as yet there are no approved clearinghouses or the process of declaring what derivatives are suitable for clearing. I'd just point out that if you are in this category, mandatory clearing also applies to intra-group transactions, but there are some exemptions that should mean that, by and large, you can get out from that. There are certain criteria listed here and certain notice periods. Turning now to where the serious burden begins for most companies, and that's on reporting. The authorities have wanted to be able to monitor the build-up of risk and the danger of contagion. So the idea is that they'll collect data, and this will be done through so-called trade repositories. The basic requirement is that all derivatives done by all companies across Europe must be reported to a trade repository by the next working day. And that means what it says. There's no size criteria or anything there. The reporting can't start yet because these trade repositories haven't been registered and approved. So the reporting dates will start 90 days after they've been approved, or the 1st of July. Or 1st of July in the case of credit and interest rate derivatives. There's a later date for other derivatives. The reporting has another sting in the tail. All deals since the 16th of August have to be reported. So transactions that were outstanding on the 16th of August but have matured now, you've got 3 years to backload those. The transactions that were outstanding on the 16th of August and are still outstanding, there'll be a 90-day period to catch up on those. But once the reporting starts, all current deals will have to be reported the next day. And this applies also to intra-group derivatives. Embedded derivatives don't count as derivatives and don't come into this. So these reporting requirements, what needs to be reported? There's a whole string of data fields, 40 or so more. There's basic data on the counterparties involved, yourself and the other side, and around the nature of the transaction. Out of this list, I'd just like to point out a couple down the bottom there. One of the things you have to say when you report next day is, what's the status of confirmations? Have they been made? Were they done electronically or manually? And are they still unconfirmed? And again, I remind you that intra-group transactions also have to be reported. Both parties to the transaction must report, but you can delegate it. So it might well be that with bank deals, the banks will offer this service and you can have them do the reporting. But on intra-group, that wouldn't really be practical because they don't know about those transactions. So if you do have intra-group derivatives, you're probably going to have to find a way of reporting those yourself. The other plank that affects everyone is risk mitigation. To minimize the risk, there are additional provisions that are being required around timely confirmations and around reconciliation dispute procedures. And a lot of this is good housekeeping, but it will be required by law now. There's a further element which, if for some reason or other you can't clear a transaction which you're supposed to because you're an NFC plus, you then have to put up bilateral collateral on that. But that bit, of course, only applies to the people who've gone over the threshold. But again, all this on confirmations, reconciliations, it applies to intra-group transactions as well. I mentioned confirmations being required there. There are certain timescales that you've got to complete your confirmations within. It says it's as soon as possible or as soon as practical, but there is a particular table here, and I hope it hasn't just disappeared for you, But in essence, what it says is that after the 15th of March, so just 2 weeks away, this rule will start to apply, and you'll have to report your transactions ultimately within 2 business days. I wonder if I could ask the operator to keep the slides moving forward, because we've lost the connection a bit at this end. So we're on confirmations. If you're an NFC plus, there will be shorter timescales and eventually working down to T+1, i.e. next day for the confirmations. There's still a little bit of uncertainty here around quite what it means by confirmations, and there is a requirement to confirm electronically where available. Again, a bit of ambiguity here, because electronic confirmation is available to anyone, but I guess one might interpret this as meaning practically and economically available. If we move forward, next slide, to reconciliations. The requirement here is that both parties to any OTC derivatives must agree in writing the terms on which their portfolios will be reconciled, and you need to do this prior to dealing. The frequency with which you have to do these reconciliations depends on the volume of transactions you've got outstanding with any one counterparty. If you've got less than 100, if you're not one of the NFC pluses, if you've got less than 100 contracts, then you only have to do these reconciliations annually, but you still have to have the procedures and the agreement in place. And that one starts to apply from mid-September. Moving on to disputes. Again, parties have to have a procedure between themselves to record and monitor disputes and monitor the time outstanding, including a specific process for resolving or dealing with unresolved disputes. There's a further requirement, probably not so relevant to many of us, but in terms of portfolio compression. If you've got more than 500 contracts outstanding with any one party, then you have to consider this. It doesn't actually say you have to do it, but you have to have a look at it at least every 6 months. Moving on to the next slide on practical implications around thresholds. If I could just sort of come back to just some of the quirks of how these rules work through. If you do go over the threshold and you're an NFC plus, once one company in your group goes over, you're all treated as over. And then each company will have to notify its own local regulator in whichever country across Europe. As I said, because of the hedging not counting towards the threshold, we hope that most corporates won't come into this NFC plus status. But even so, we'll expect that your banks will ask you to make various representations about what your status is, because they need to know as to how they deal with the transactions. Now, ISDA is working on an NFC protocol that will be a way of adjusting the agreements that you've already got to reflect the requirements of EMIR. There's one other little thing around clearing. With all this going on, we suspect that there might well be a move for people wanting to put credit support annexes in place. Even if not required by the regulation, there could be some cost benefits, because if you do a transaction that's collateralized, the bank will have to hold less capital against it. And of course, if you do put up collateral, these things tend to be two-way, so you're getting the credit risk of your bank counterparty reduced as well. But the companies that might be interested in doing that will have to think whether they can cope with the liquidity requirements, and indeed whether you've got any negative pledges that might prevent you from doing that. I would just remind you that pension schemes are financial, so they straight into mandatory clearing, although there is a phasing for that. Moving forward to the next slide on practical implications and reporting. Again, you might well want to adjust your agreements to reflect the responsibilities on each side for reporting, and there probably need to be a waiver of any confidentiality, because you're reporting your transactions and the other party's involvement in it to an outside party. The bank, as I said, can report for you, but if you delegate that, you still have responsibility. So if something goes wrong, it's still back to you. You'll need to think about capturing all the deals since the 16th of August, when all this started. Have you still got the data records? One of the things you have to put on your returns is your legal entity identifier. Well, they don't exist at the moment. So there'll have to be some sort of interim arrangement, and whether that's your company number or what, I confess I don't actually know. I know in the States they put in place a sort of interim arrangement because the LEI is intended to be a global system. Again, on reporting, yep, intra-group have to be reported, same timescales, but again, you might decide that your central treasury does the reporting, and that's perfectly possible. Because of the need to report intra-group transactions, you might have to think about connecting to a trade repository, and of course there could well be a cost attached to that. On risk mitigation, we talked there about need for reconciliations and so on. Confirmations form part of that, so your agreement with your other party will probably need, in fullness of time, to start dictating who's responsible for what and undertakings as to timescales. There's still some debate about what counts as a confirmation. For people who are not doing many deals, it might well be the bank sends them a confirmation and says, if we don't hear from you, we'll deem that confirmed. Not quite sure whether that still counts. I mentioned earlier that there's a push towards electronic confirmation, and as I keep saying, internal trades also need confirmation. And of course, there's these procedures for reconciliation and disputes. You'll need to agree what they are with each of your banks and document that, or we expect there will be various market standards being developed on that, which we hope will be helpful. So that, in essence, is a run-through of the rules. If I can now turn to Jenny to have a look at other things that are going on in the world of derivatives.
Great. Thank you very much, Martin. And my name is Jenny Costco. I work in Goldman Sachs' Government Affairs Department. Our role is to navigate the policy and political terrain for Goldman Sachs, but also for our clients, and we spend a lot of time on the European regulatory agenda. As Martin mentioned earlier, EMIR is not the only game in town. There are a number of pieces of legislation on the horizon that impact non-financial companies, and I'd like to spend a few minutes speaking about three of them that are particularly relevant: the EU financial transaction tax, MiFID II, and margin for non-centrally cleared derivatives. So I'll start first with the financial transaction tax. As many of you know, in September of 2011, the European Commission put forward a proposal for an EU-wide STT. The proposal was not supported by all EU countries, and it was abandoned shortly thereafter. A number of countries in recent months, however, have decided to go ahead with their own national STTs. France implemented its FTT in August, and Italy is now finalizing its FTT decree, where the tax will apply to some products as early as next month. However, and more relevant, in December of last year, 11 European countries, including France, Germany, Italy, and Spain, but not the UK, agreed to proceed with a coordinated FTT under what is known as the Enhanced Cooperation Procedure. And in light of this agreement, the European Commission released a proposal for a directive taxing all transactions with an established link to the 11 participating countries. The goal of the directive is to harmonize taxation of financial transactions and to ensure that institutions make a substantial contribution to covering the costs of the recent crisis. The proposed scope of the FTT is wide, covering stocks, bonds, repos, and relevant for this audience, derivatives. The minimum tax rate on derivatives is 1 basis point based on the notional, and there are only very limited exemptions in place, for example, for spot currency transactions. Importantly, the extraterritorial impact of the proposed FTT is considerable. It will apply when one counterparty is based in a participating country or when the product is issued in a participating country. The goal of policymakers is to have the joint FTT agreed and implemented by the 1st of January of next year. However, the proposal is currently under negotiation and needs to be unanimously agreed by all the 11 participating countries. This could take several months, leaving some to judge that the proposed implementation date of next year is extremely ambitious. I'll then move on to MiFID II. Martin spent a lot of time speaking about clearing, confirmations, and reporting in EMIR. MiFID II is the other side of that, focused on execution of derivatives transactions and transparency to regulators and to the market at large. MiFID I, its predecessor, came into force about 6 years ago, and broadly speaking, its intention was to do two things: harmonize European market regulation and foster greater competition between trading venues, providing greater choice for end users and non-financial companies. Because of the financial crisis and changes in market structure, the European Commission decided to undertake a more fundamental review of MiFID. And in October of last year, they proposed MiFID II, major overhaul of market trading and conduct of business rules. There are three objectives. Firstly, as Martin mentioned earlier, enforce further the G20 mandated regulatory oversight over OTC derivatives trading. Secondly, expand the MiFID regulation, which currently today applies only to equities and covering derivatives, bonds, structured finance products, and emissions allowances. And finally, focus on increasing investor protection and market stability. Departing from the purely cash equities focus of MiFID I, as I mentioned, the product scope extends to fixed income and derivatives and will apply and impact counterparties who trade these securities products, like non-financial companies. In particular, the provisions on execution and transparency will have the greatest impact. These new rules will, firstly, prescribe that all trading of cleared and sufficiently liquid derivatives be traded on one of three trading venues: regulated markets or stock exchanges, multilateral trading facilities, such as Tradeweb or Bloomberg, and then a new catch-all trading venue category called organized trading facility. In addition, there are significant new provisions calling for additional pre- and post-trade transparency of derivative transactions. Some of the specific proposals under consideration could have an adverse impact on how corporates and end users transact and hedge certain business risk. Specifically, we expect the result for MiFID II to encourage a move from voice trading to electronic execution for cleared and sufficiently liquid derivatives, full disclosure of all quotes for clearing eligible derivatives, and as I mentioned, significant pre- and post-trade transparency, including full disclosure of quotes to the market at large. In terms of timing, MiFID II is still in the formulative legislative process, which is expected to be completed in the coming months. With the technical rulemaking taking at least a year or more, as we've experienced in EMIR, implementation may not occur until late 2014 or even beyond. Moving on to my final topic, which is margin for non-centrally cleared OTC derivatives. As Martin mentioned earlier, following the G20 mandate to clear standardized OTC derivative contracts through CCPs, the G20 leaders in 2011 agreed to add margin requirements on non-centrally cleared derivatives to the overall reform effort. The FSB, in its role as leading the implementation of the G20 commitments, tasked the Basel Committee and IOSCO, which is the Basel Committee's equivalent for securities regulators, with formulating global harmonized standards. They created a special working group which commenced its work earlier this year, and in a consultation paper issued last summer, the working group proposed a combination of variation and binding two-way initial margin approach for financial entities and systemically important end users. More recently, the working group issued a second consultation paper which proposed, among other recommendations, a 50 million euro threshold and a phase-in period up to 2019. What does all of this mean? Basically, for NFC plus counterparties, as with cleared trades, margin requirements for certain systemically important end users will become higher and potentially making it more expensive to transact in non-centrally cleared derivatives. In conclusion, the regulatory environment in Europe has been much more of a marathon than a sprint in my experience. And given these measures I've highlighted are still pending implementation, we've only just started the first part of the race. I'll now turn it over to Joe Hawks for the discussion.
Thank you very much. My name is Joe Hawks, and I'm Group Treasurer at MISIS, and I'm here really just to respond to some of the things that have been spoken about today and how I'm thinking about how they might be implemented in my organisation, and perhaps some of the questions that are being raised as I listen to what's being said. First of all, I would say that we haven't done any planning at all as yet, and I've been on a fairly steep learning curve over the last sort of month or so, courtesy of Martin, actually. Some of the good news is that I think we have a lot of quite good systems in place at MISIS already, so we will be able to respond fairly quickly, I think. But we do interest rates, we do FX, we do embedded derivatives, we have a pension fund. We're a non-financial company, and I don't think we're going to hit any of the thresholds. So I think I will be in the position that probably most of the people on the call will be in. So we actually don't do any interest rate swaps as we speak. So we may be lucky in that we won't have to become fully compliant at the first threshold date. But one of the things in listening to what Martin has been saying, I think that is hitting me the most is that we do, as a global international company, do a lot of internal cross-border cash flow and trading, and we have a relatively sort of sophisticated process whereby we have all the subsidiaries hedged with the centre, we hedge in the market on a collective basis, and we are daily moving money around the group through the mechanism of internal swaps and internal spots and external trades to back it off. So from my conclusions of what I'm hearing, we are going to have to set up some reporting systems that enable us to report those internal trades and more specifically to document the fact that we have some confirmation processes in place, which in practice we just don't at the moment. We control most of the intercompany trading from Treasury, so we don't have any formal confirmation process. So I think we'll have a lot of work to do there. I was hoping we might be able to outsource some of the reporting requirements for the trades that we do with our banks. My experience so far is that we've had very little guidance or approaches from our traders in terms of how they want us to behave and whether they're going to take on any of this reporting. But I'm sort of reasonably confident that we will be able to do that ourselves for the externally traded deals. We have an electronic. We use CMS, the MISIS CMS system for electronic confirmations. So I think it will be, fairly okay for us to demonstrate that we have the confirmation processes in place. But I am curious, and maybe it's a question for Martin as to, with the deadline sort of approaching so rapidly, what do do you think the consequences are going to be if we don't get these systems in place by July, and where do we go if we get it wrong? And who do we know? Who do we go and talk to about notifying that we've got these things?
Well, I think it's interesting because, as far as I'm aware, there aren't any rigorous audit and checking type of requirements. So an awful lot of this is down to trust and people making representations that they are in compliance and obviously using their best endeavours to do so. The rules have come along very much at the last minute, so people are very short on time for implementation. One would hope that some of the regulators would take a reasonably lenient attitude to this, but of course we've yet to see on that. I wonder, actually, if I may at this point, ask to bring up the results of the poll that we had earlier. That's quite relevant to what you were just talking about. So, if we bring up poll question 1, what we see, this was asking the question about has your company started a program of preparation. We've got 38% saying that steps are in train, but 41% they're only just starting to think about that, and 21 have very honestly said that they're not yet thinking about it. So 60 odd are in the only just starting or not having done anything category. So I think it's not unusual for people to be only now getting to grips with this. If we bring up poll question 2, or the results of the poll, this one was asking, have your banks and other service providers started to offer EMIR-related services? The first option being, yes, it's happening from lots of angles. Just 17% have noticed that. 44% say that we're beginning to hear from a few, but there's still 39% where they haven't really had any outside advice from banks or service providers. So we're all just starting on this, I think.
Yes, that's quite interesting feedback, I think, especially with the deadline being so close. Well, that's very helpful. I was also just curious, again, coming back to the international aspect that impacts on my business. Is it, can all of the trades be captured and reported in, to one place, or does there have to be some compliance reporting? If you're an NFC and you're under the threshold, can it all be done to one?
I think this will rather depend on what you want to do. The trade repositories that collect the data are international, even global. So you don't have to find one in your own local country. Whether it's a question of shopping around to find the one that's got the best service, the best fees, remains to be seen. I mean, within a group, it's probably convenient just to use one once you've identified that one. But equally, if you're having your bank doing some of the reporting, they might well be using their preferred trade repository. But I don't think it matters that you use several different trade repositories. Ultimately, all that data is going to get collated at the regulatory authority level so that they can view what's going on internationally.
Yes, it's interesting. I mean, my team may speak differently, but I don't think we've even been approached by our bankers, with them wanting to say, get ready, so you need to declare that you are actually an NFC so that we can trade with you. And we are a company that's fairly recently been taken over by private equity, so we have gone through a complete revamp of all of our activities, and we're still negotiating with our ISOs. We have looked at DSAs, we're rejecting those for the reasons that you said, for liquidity, so we wouldn't tend to go down that route. But it is interesting, and so what will be the consequences if we don't get our systems up and running by July, and we have we fall into the first category of having interest rate exposures and hedges?
Within EMIR, it doesn't actually specify any penalties as such, but what it does say is that each local regulator should introduce a suitable enforcement and compliance regime. So there will be local secondary legislation which will introduce the idea of penalties and giving the FSA power. Because, of course, at the moment, the FSA in the UK doesn't really have any authority over non-financial companies. They're not regulated as such. But once the various statutory instruments go through, we will all, in a way, become regulated companies. Okay. Well, thanks very much for that. At this stage, if I could introduce my colleague, Michelle Price, who's been monitoring various questions as they come in. I wonder, have you got any questions you could put on behalf of the audience for us?
Well, we've had probably on average a question a minute come in, so apologies, we won't be able to get to all questions today. There's been a lot of questions come in on penalties, Martin. What are the penalties for non-compliance?
So, in effect, that was the bit I was just talking about there, that at the moment, there isn't even the legislative framework to impose penalties. In time, that will come into place. As I said, I hope that the regulators will take a rather lenient attitude because they haven't left us much time to implement all this. Well, what's happened is the political process got rather extended and delayed in terms of approving the legislation, and that meant that everything has got squashed at the far end because the end implementation dates haven't been pushed back. So we as users are the ones who are suffering.
Thank you. There's also seems to be some confusion in the audience on data capture. You mentioned the 16th of August 2012 on one of your slides, and a few people are asking, is that right, or should it be 2013?
I'm happy to take that one. It's actually 2012. This is the front-loading phenomenon that came out of EMIR. That's probably, at least from my perspective, the biggest issue for end users, and actually also for financial companies like mine. So what happened was the 16th of August was when the actual regulation was published, not the technical standards. And what it means is that everything from that date, if you are NFC Plus, must be cleared from that date, despite the fact that the clearing rules have not actually entered into force yet. And I believe, Martin, the same is for reporting, and it's due to the way the rules were drafted, but the rationale is also around anti-avoidance. There are some policymakers who think that, if there is a lag time, people will go and try to do non-centrally cleared deals in that lag time. So they've put in this provision, which, is unfortunate because it creates problems in terms of how you price contracts, at least from a bank's perspective, but also a lot of confusion for, non-financial companies. I don't know if you...
No, I think that's right. Yep, you've got to look back to last year, and all those transactions done since then will have to be reported in time. They don't have to be done instantly.
And you said that only that were outstanding currently, you had 90 days to report them, and anything that had matured since you had a longer period to report them.
That's right. That's exactly right. So if they're still outstanding when all this starts, you've got 90 days to catch up. If they're actually quite old historic ones, you've actually got 3 years to catch up.
I've also had a lot of questions on reporting. Two that just jump out is, do you need to complete all the fields in reporting? And a simple vanilla spot transaction is also caught.
Well, I can tell you about the spot. Spot doesn't count as a derivative, so it's just nowhere in this. It doesn't count in any sense at all. In terms of the fields, I suspect that even if it's a nil entry, you'll probably be required to put that in, if only just to check it's not a misprint or something. Do we have time for just one more question?
Yes, there's quite a few questions coming in on geographic scope, and just trying to clarify what the geographic scope of EMIR is.
Well, EMIR is the European rule, and it will apply to any transactions done by an EU entity. An EU is, broad definition, it's the EEA. So even if a European company does a deal with a non-EU bank or other counterparty, that still is caught. Good. Well, I think time is catching up with us. If I could thank everyone who's put in a question, and apologies if we've not been able to answer them. To the extent we've got a contact and are able, we'll try and respond to you direct. I should just mention that this event is being recorded, and it will be available later on our website in a day or so. I'd like to thank our speakers who've joined me today for taking part in this. I'd like to thank Goldman Sachs for their sponsorship, and thank you for connecting into our webinar today.